Good morning and welcome to this Wednesday, March 31st, 2021 edition of Trading Places Live here at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. I've got some pretty good economic reports out this morning. Futures on the NASDAQ actually leading today. It is the final day of March. I don't know about everybody else. I'm not going to miss it. Not from a growth stock perspective, that's for sure. Been a rough month, but we are moving into April. Starting to see some signs of money rotating back. One big company, of course, that I follow pretty closely. And of course, those of you who are at Earnings Beats and have followed our portfolios, you know this stock pretty well, Tesla. They tend to go on pre-earnings runs, and I saw the volume yesterday pick up, really solid, hollow candle gapping up this morning. We'll see whether or not this is the start maybe of a typical Tesla pre-earnings run, or if this will fizzle out like other attempted rallies the past month to 6 weeks or so. But at least for one day, Tesla was looking pretty good. We'll look at that chart in just a little bit. Yeah, I mean, overall, it was I think the news that came out this morning, and we're going to go over it in just a minute, but the economic news I thought was pretty strong. And that could help us, at least in the short term, kind of get things back on track. We'll see. But before we get into any of all that, let's go over to Earnings Beats quickly. For those of you who are unfamiliar with what we do, you can go to earningsbeats.com. You can see, actually, I'm not sure if this worked or not. Hold on a second. Let me try this again. All right, hopefully that should work. It was just something was showing up weird on my screen. Anyhow, if you are new to Earnings Beats, we have a free newsletter. So I really just wanted to point that out. Just type in your name, email address, hit the subscribe button. This morning, one of the stocks I go over, I'm going to show you the stock that we featured in this morning's free newsletter. But it's one of my favorite trade setups, earnings gap trade setups, really of all time. I mean, this is what I look for. If I had to pick one trade setup, it would be the one that I featured this morning in our Earnings Beats Digest, and also sent out as part of our daily market report yesterday. It was just one that I had seen reversing off of major gap support from earnings. So we'll talk about that. But this newsletter really is just I try to be educational, provide some good information, not only about the market, but how we view the market and the way we look to trade or invest, some of the keys that we look for in terms of earnings and relative strength and so forth. So I think it's a good newsletter. You got an opportunity really for some trading opportunities in there as well if you choose. But anyway, just go to earningsbeats.com, type in your name, email address, hit that subscribe button. It's completely free, no credit card required, and you can unsubscribe at any time. So no fuss, no muss there. But let's jump into the market action from yesterday. We saw the Dow Jones Industrial Average down 104 points, the S&P down 12.5. The NASDAQ finished down 14.5, but on a relative basis, it actually outperformed the Dow and the S&P. And that was not the case early on. Early in the day, the NASDAQ was lagging. So we saw a little bit of this rotation yesterday. Mid caps were up more than 1%, small caps up 1.5%. So again, moving back into small caps, which I thought was pretty good. Discretionary, financials, and industrials, three aggressive groups leading the market yesterday. These, I believe, were the only three in positive territory. So again, that's another little sign. We'll see. I mean, industrials have been strong. This was a group that I've been featuring a little bit more of lately in the daily market report. I think in the recorded version of Trading Places Live that I did at Stock Charts yesterday, I did a break it down segment of the industrial group. And so this is definitely, I mean, you know, we're getting a breakout. This is one of the aggressive areas that tends to lead during secular bull market advances. So it's important to recognize when you see a major group like this making a breakout. Financials been one of the leaders, of course, with Treasury yields rising. Financials have done exceptionally well. They bounced back a little bit yesterday, although we may have seen a short-term top here. I don't know. If we do break out, first of all, look at that PPO way down. So if we make a breakout off of this 20-day or even threaten a breakout, be careful if it fails to hold. I love the financials going forward. Short term, I think it's a little dicier, especially if they make a breakout and they can't hold that breakout with a negative divergence. But as far as I'm concerned, if some of the other aggressive groups tend to maybe pull back, I think that could open the door for areas like discretionary, which have pulled back already. You know, we had a high in discretionary stocks back in February. I said how rough March was. Well, we've seen a bounce back in discretionary. This is better than technology. But that first week of March was brutal for both discretionary and technology stocks. And you can see it on the NASDAQ as well, the big drop at the beginning of the month. So this is an area that's starting to rebound a little bit. I would be fine if heading into earnings, we begin to see more money rotating into discretionary and into technology. That's what I'm hopeful of. We'll see whether or not we get it. Staples, been on fire of late. Would I be rushing into Staples here? No chance. Now, Staples recently, I mean, obviously March, very strong. March is typically a strong month for the defensive areas. That's when we tend to see rotation out of aggressive areas. Earnings are in our rear view mirror. It's too early for a pre-earnings run up. And so March tends to be one of those months. It's really March, June, September, and December where you tend to see the defensive areas begin to shine a little bit while we take a little breather in some of the aggressive areas. That is not unusual. Now, the amount of strength in consumer staples is certainly higher than normal, but the fact that we're seeing rotation is not. Now that we're going into April, I've said this before, and I'll keep saying it. A secular bull market, you want to see wide participation. You want staples to break out from time to time. You want industrials. Obviously, these are the aggressive groups. I want energy and materials to do well. Not necessarily lead. I don't think they're going to lead the market in 2021. But if you're looking at an absolute basis, I want to see the stock market dragging everything up with it. So I love the fact that staples are broken out. But do I think they're going to lead? No, I do not. And then finally over here, I had to put the chart of the dollar up because it's been now several months, probably at the end of last year, I was talking about, and I'm going to talk some more about this, anybody who hasn't seen this discussion, but I've been just talking about the dollar moving higher in 2021. And that's one of the reasons why I struggle with energy materials, even though materials, I think on a relative basis, breaking out to a new recent high, looking good on their absolute chart, but there's a headwind for materials and energy, and it's called the dollar. When the dollar is on the rise, those two groups tend to underperform. Well, I think it's rather undeniable now. The dollar is rising. Those maybe who didn't believe, a few months ago when we first started, opened the year, looked like we were, strengthening, pulled back. That didn't last. And you can see we have been surging back to the upside. And this relates simply to the fact that the way the bond markets are trading here in the US and Germany, it's just telling us that economic growth is expected to be much greater here than it is in Germany. And the reason I picked Germany is the US and Germany, for whatever reason, tends to be the most highly correlated countries. So when I look at what I'm expecting maybe in the US or maybe what I'm expecting in Germany, I look at the two just to see what's going on because they do tend to move in very similar fashion. But interest rates here in the US are moving up much faster than Germany. And that is why I was calling for the dollar to strengthen. And you'll see it. I mean, this is the chart I'm going to show you is a really good predictive chart, but we'll get to that. So just hang in there. 10-year Treasury yield. All right, we had some good economic reports out this morning. March ADP employment, 517,000 was the actual. 500,000 was the estimate. So we beat the estimate. February was revised higher from 117,000 to 176,000. Now I'm looking at the 10-year Treasury yield and it's down about 1 basis point. And you might think, well, why would it be down if economic activity is picking up? Well, the bond market, just like the stock market, it anticipates data. I mean, it wouldn't surprise me if short term we topped on the 10-year Treasury yield for a couple of reasons. Number one, We're starting to get that economic news that we expected and that the bond market was calling for. That's why you see yields going up. So I think part of it is in terms of treasuries, it's a sell on the rumor and then buy on the news. When you sell on the rumor, when you sell treasuries, the yield goes up. Now, if it's a buy on the news, you'll see the yields come back down. The PPO would also argue for a pullback here. I mean, you can see that PPO from here, we were fine. You can see the high on the PPO match the high in price. The last high we had, you can see we went up. The PPO did not confirm. We pulled back one more time, and now this one, it just looks like it's getting a little bit labored. And that doesn't mean I don't think the 10-year Treasury yield goes over 2%, because I think it will later this year. But I think we could pull back from here. I mean, that PPO is not even budging to the upside on the last 3 days rise in Treasury yields. Also, a little bit of a reversing candle there at the top, right at resistance. I don't know. It just seems like maybe we're setting up for a little bit more weakness in yields. And if we do, a lot of folks that have been trying to tie yields to technology stocks, I would imagine would go back and start buying technology stocks again. So let's watch the yield and see, because that could be a short-term catalyst for technology. As I've said before, I think it's hogwash. If you go back and you look at the last major rise in Treasury yields, technology led the market. So, you know, I think the market sometimes gets into what's called a recency bias. So they see something that's happening recently and they just say, okay, that's it. It's doing, you know, the stock market's doing this because this is happening, because that's what's been happening the last 6 weeks. So therefore that makes it, you know, it's set in gold. You know, one of my, you know, when I think back to the first 10 years of the decade, or of this century, I mean, and then the last 10 years, we've had different periods of bull markets with a rising dollar and also with a falling dollar. But I remember back in, you know, the 2005, 2006 timeframe, that everyone wanted the dollar to be weak, because whenever the dollar's weak, that means stock prices go higher. No, it doesn't. It just, that was the recency bias. We've been in a beautiful bull market for 10 years. The dollar's been going up. That argument doesn't pan out anymore, so you don't hear it anymore. Recency bias, you got to be careful, because a lot of times news agencies and even people that you think are experts, they get into the recency bias. When I see an analyst come out from a Goldman Sachs, now I know these folks are really brilliant, but when I see them talking about how interest rates are going up, that's bad for technology stocks. Well, interest rates are just one half the puzzle. It's also about growth. You know, if you got 6.5% growth and 1.5% interest rates, that's nirvana for growth stocks. But anyway, what do I know? All right. So anyway, 10-year Treasury, I think we need to watch this. Short term, I think we could be topping. I thought maybe we were topping back here, I'll be honest. The PPO didn't suggest it, but we had just gone up so much, I thought, okay, we're going to pull back. Well, we didn't. We kept going higher and higher. Now we're starting to see that weakness in the PPO. All right, let's talk a little bit about the dollar. And this is one of my favorite intermarket relationship charts. And this is one that, I'll be honest, I was inspired by John Murphy. I mean, his intermarket work that he did, I was always fascinated by that, because I'm always trying to figure out what makes the stock market and the bond market tick, and what makes the dollar tick, and, you know, and looking at relationships. And it's one thing to say, you know, to have recency bias and say, well, for the last 6 weeks, the dollar's been going up. Oh, and interest rates in the US are going up, so therefore the two are tied together. They're not really, not in a global market, not anymore. It's more about how the rates are doing here in the US versus Germany, or versus other countries. I like I said, use Germany. But this is the yield. The top part of this chart is the US Treasury yield, 10-year US Treasury yield minus the German 10-year Treasury yield. It's the difference between the two. It's not one divided by the other. Okay, we're not looking at a relationship in terms of the prices of the treasuries. What I'm looking at here is simply the yield. So right now the yield in the US is 1.75. The yield in Germany is a minus 0.27. And if you take the difference between the two, you get 2.02. That's what this is. It's just the difference between the two. So when it's rising, it's telling us that the US versus Germany rates are strengthening. Now, it could be that the US is going down and Germany's going down even faster. If that's the case, this still goes up because it's that difference between the two that we're looking at. All right, so once you have that plotted, and all you have to do on stock charts is put in $UST 10Y minus $DET 10Y. If you do that, that gives you the difference between the two. Now down here, the next panel is the US dollar index. Now, if you just glance at it, you kind of see, up, down, up, up, down. And then, of course, we were going down recently. And we'll talk about that in a second. But overall, I mean, I think if you just glance at this, you'd think there seems to be a pretty good correlation here. Well, plot the correlation, which is another great tool at stock charts. This is the correlation coefficient. And so I can plot the difference between the two countries' yields, comma, US dollar, comma, 20. So it's looking at the relationship between the dollar and the difference in the yields between the two countries, and it's looking at it over a 20 period, or 20-week period, because it's a weekly chart. So over 20 weeks, and it's simply plotting between +1, which is perfect correlation, they're going up hand in hand, and -1, which is inverse correlation, meaning they're going in opposite directions. And what you can see, I think, pretty clearly, is that we spend most of our time above 0. We spend a lot of time above 0.5. So these two are pretty positively correlated. But what I've done is I've highlighted periods where we've seen inverse correlation. So for instance, here the yields in the US versus Germany were rising. Here the dollar was going down. All the green shaded areas are looking at the same thing. Here we got the yield going up in the US versus Germany, and dollars going down. Same thing here. Yields in the US going up faster, dollar going down, and that's what we're seeing here. Dollar or the yields rising in the US faster, and then dollar going down. Now the red shaded area was the opposite. That's where we saw the yield in the US dropping versus Germany, yet the dollar was going up, setting a new high, went all the way up to 103 while this was happening. So all 5 of these have essentially led to the inverse correlation, significant inverse correlation that you see. All right, now look at what happens after these periods of inverse correlation. So here, yield was going up, dollar was going down, dollar comes roaring back. Yields going up in the US versus Germany, dollar going down, dollar comes roaring back. Again, yields in the US moving up, dollar going down, dollar comes roaring back. You kind of get the feeling the dollar plays catch up here. Look at it on the way down. Yields were dropping rapidly versus Germany. Dollar was going up. Inverse correlation, dollar tumbles. And so what I was talking about late last year is we started seeing the yield in the US move up pretty rapidly versus Germany. That should lead to strength in the US dollar. But the dollar kept going down. Well, look at what's happening. Now the dollar is starting to rally back. And look at some of these moves that we've seen in the dollar. So when I'm talking about the dollar rallying, I'm not talking about for a couple months. I think this is going to be a 2021 deal where we could go all the way back up to 100, maybe more. Maybe we get back up to that 104 level. I think the dollar is in the process of making a big move to the upside. So keeping that in mind, when you've got a rising dollar, now this is a 20-year chart. So this was the first decade this century, 2000 to 2010, really 2008. But look at the dollar going down. And look what happened to energy relative to the S&P 500. And look what happened to materials relative to the S&P 500. These groups were leading when the dollar was weak. Then we went through this transition. You can see the same thing happening here, transition. Then the dollar bottomed and started trending higher. What happened to energy and materials on a relative basis? They've fallen apart. So Now what I'm looking at is the dollar finally beginning to do what I thought it was going to do. And while the dollar was going down, we actually saw a pretty nice rise in materials. Even that didn't help energy, which was kind of surprising. But as the dollar has started to move back up, short term, we're still fine in terms of the relative strength of energy and materials. Although energy looks like maybe starting to roll over. We have to watch that. But not materials. Materials at about a 2.5-year high in terms of relative strength versus the S&P. But we've seen this before. I mean, we've seen materials here. We had the dollar weak for a while, and look at materials leading. And then the dollar had one of these moves, and look at what happened. Materials straight down, energy straight down on a relative basis. That's the important part. Doesn't mean necessarily that the groups went down. I know energy did. But it doesn't mean that the groups will go lower. Maybe they just underperform, because that's what this relative strength line is telling us. But we've had a nice run in materials. We've started to have a nice run in energy. But we're in a decade where these two areas have underperformed while the dollar has been moving higher. I think we're going to have to watch this, because if the dollar keeps moving up, it's just going to create a headwind for energy and materials. All right, let's keep moving on. I want to look at a couple of stocks here. First one I want to look at is Tesla. I talked about Tesla, in the open. This is the candle I'm looking at. Now, we still got work to do. Don't get me wrong. We've had candles like this before. Big one there. Here we got one. Here's another one last week. Saw a pretty good move. But we did close on the high. We cleared yesterday's low. Volume picked up. And I've been talking about this. AD line has remained very strong. And I said if we got a couple of good days, we'd be at a 52-week high. Well, there's one of your good days. And you can see that AD line not far now from breaking out to a new high. Tesla, over the last, I'm going to give you some numbers here because this is important. I've talked about this too. But if you're new or you haven't listened, I've got some numbers here written down. So let me see if I can find them here. All right, here we go. The last 5 quarters, and actually I would look back, it goes back more than 5 quarters, but the last 5 quarters I looked at, and essentially the 4 to 5 weeks prior to earnings, Tesla, the last 5 quarters has made these advances: 25%, 20%, 70%, 78%, 45%. Those are the actual returns of Tesla the last 5 quarters heading into earnings, from the lows just before the month before earnings. So what I'm thinking is from, right around in here, let's say yesterday was the low heading into earnings. We're 4 weeks out from earnings, by the way. So let's say that 591 is the low. 20%, which is the worst quarter, worst pre-earnings run that Tesla's had in the last 5 quarters. If we got 20%, that'd be $118, which would take us back up over 700. That's worst case scenario over the last 5. Now, I know money's rotated away from growth. There's a different attitude right now. Maybe it doesn't even happen. Maybe we go up and we hit this 20-day. Maybe we don't even get the 20-day. Maybe we roll back over and growth is just dead. We're going to find out. I don't believe that's the case. I don't believe that's the story, but that's the story that everyone wants us to believe right now. Let's watch and see what Tesla does here heading toward earnings. 4 weeks out right now. And I mentioned this AD line. I want to also show you another stock. This was the one that was featured in the Earnings Beats Digest. Again, if you haven't signed up, go to earningsbeats.com. Just put in your name, email address. 3 times a week, I'll give you a chart, which, it's probably going to be educational, but it might be a trading opportunity for you. All right, so you look at this chart, and I know most people probably look at it and say, oh, this is awful. Probably any technician I would talk to would say, this is awful. And it comes down to your hierarchy of things of importance. So most are going to say, well, the PPO is negative. That's awful. It's trending below the moving averages. That's awful. We got a death cross. The 20 was below the 50. That's awful. I can't argue with any of those points. They're all bad. I mean, technicals in the short term look bad. And buying a stock when technicals look bad generally doesn't work out well. But here's the but. I'm going to annotate this. And one of my favorite trades is when a stock works its way back to a major gap support level. Notice here, Zscaler on this move up, gapped up early September. That's when the market topped. Growth stocks went out of favor back then. And we set this top at about $162. Came down, rallied back, couldn't get through. Came down, rallied back, basically just went through 3 months of consolidation. Earnings came out, Zscaler explodes to the upside. Big move. Gaps up, continues rolling. Look at the volume down here. This is really important because normally what will happen is when a stock sells off, it usually will find support at the top of gap support when you have a big move like this with heavy volume. The reason the top of the gap support is so critical is that market makers are on the other side. They see the demand for a stock after the earnings come out. Everybody's putting in their buy orders. And so they're going to determine, and don't ask me how they do it. I have no idea how they do it. But when a company comes out with good news, generally you're going to see a gap up. Normally what will happen is you'll see a stock gap up and eventually come back down and fill the gap. Now, maybe it happens that day because you got a lot of volatility. Market makers are short. When everybody's buying at the open, they start off on the short side because you're not going to have as many people willing to sell as you're going to have willing to buy after great news comes out. It's just the way the market works. So market makers fulfill their role by providing liquidity. Now, there's good news out there. They're not going to give you the same price that you had at the close yesterday. They're going to make you pay up. If they're going to take the sell, if they're going to sell, they're going to want to get their price. So they gap it up. They're on the short side. What normally happens, they drive prices back down. They make their money on the short side. When you see a gap up in a huge candle like this, what it tells to me, what it screams at me, is that you've got tremendous demand for a stock because you're not only gapping up, you not only had great earnings, but you're forcing market makers to cover their shorts. That's why you get these candles like this. It's because market makers that go short at the open are looking at the volume coming in and they've got no choice but to cover and go long. And so a stock goes from 160, well, over the next few months up to 230. But if you look back, look here, look at the volume. See, same difference. We never even came back to the top of gap support here. This was a breakaway gap that just kept running. Here, we're getting another one. Usually they're going to come back. And look at what Zscaler did yesterday. It went down to a low of 160.66 below. I think this is like 163.45 or something. I don't know. Somewhere right around there was the number where it opened. We went below it intraday, came back up and closed above it. Now, I can only tell you based on experience. I can't give you any kind of a guarantee. You know, there's no way you can do that with anything. And if the growth stocks keep going down, Zscaler is likely to go right down with them. But in the short term, I will be shocked if we don't see a reversal in Zscaler. I actually bought it at the open, or excuse me, at the close yesterday. I sent it out in the daily market report. It was one of, I think, three or four stocks I put in the daily market report because they were reversing right at a key support area. This one in particular just gets my attention because this is my favorite trade. I love trading the top of gap support on candles like this. I didn't even see it here. I probably would have bought it here if I had seen it coming down. But it's coming down again, so this is the second time. If it breaks, I'm going to get out. I'm not going to say, well, you know, it should have held, so I'm going to hold on. No, it should hold. I imagine my stop, and I haven't said it yet, my stop will probably be below yesterday's low. That's the most I will take in terms of risk on Zscaler. I'm looking for this to be the reversal back to the upside. Now, what I would have preferred would have been more volume yesterday. If there's one thing I wished I'd seen more of, would have been on this breakdown, triggering more stops. Market makers are taking those stocks going long, and you get the reversal. That's what I would be looking for, but that didn't happen. Anyway, I wanted to point that out. One other thing I want to talk about this morning, and I know market's getting ready to open, so I'll try to make it quick. But I had a mailbag question come in about two stocks regarding their AD lines weakening. And they're both portfolio stocks. And the question was essentially, you know, should I sell? Well, first thing, I'm not a registered investment advisor. Earnings Beats is not a registered investment advisor. No one at Earnings Beats is a registered investment advisor. So we don't advise. We can't advise. I'm not licensed to advise. So keep that in mind. All I do is try to educate and point out what I've learned over the years, what I see on the charts, and then everyone's got to make their own decisions, what they want to do. What I will say about the AD line, let me get some water here. I can always tell when the pollen's starting to hit. I don't know if any of you out there suffer from it, but man, March and into early April usually gets me. Anyhow, the thing you have to understand, or from my perspective, I've been talking a lot about AD lines and how important they are. They're not my number one. They're not even close to being my number one. My number one is price and volume. I mean, Applied Materials has been going up, beautiful looking chart. Volume has accompanied this move throughout. And when you look at it, you say, well, the volume really isn't that much from what it was, a year ago. Well, there's two things here. Number one, I can look at it and see that the bars are higher. That's number one. Number two, the price is triple what it was a year ago. So this volume, dollar volume, if you take the volume, number of shares times the price, the dollar volume, and this is one thing I've asked for at stock charts, I'd love to see them add dollar volume, because dollar volume would be significantly higher on Applied Materials based on the price being so high and the volume being heavy. But unfortunately, we don't have that to visually show you. So you've got a stock that's trending higher on massive volume, and it's one of the best stocks. I don't know if it's the best, but it is certainly one of the best semiconductor stocks right now. Over the last 4 or 5 months, look at the relative strength here in Applied Materials. The semis in general were going much higher until February and then have turned down. But as they've turned down, Applied Materials is broken out, showing even more relative strength. So I look at a stock like this, and I'm not going to sell because the AD line's going down. There's too many other positives on this chart for me to sell because of the AD. It's kind of like selling because the RSI hit 70. Well, if you got a really good stock, the RSI is probably going to go to 80 or 90. And if it does pull back from 70, it's probably going to go right back up again as it trends higher. It's just a little bit of RSI can give you a short-term, very short-term signal. It doesn't mean to get out of the stock and stay out of it. The AD line, would I prefer the AD line to have continued going higher like it was back at the end of the year and into January? Absolutely. I would feel much better if this AD line was soaring too. But you can't have everything. If you're always going to look for one thing on a chart that makes you want to sell, you'll sell every stock, because there's something on every chart that's not good. And it's also one of the reasons why I limit my charts and only have a couple of indicators that I trust and that I've worked with and that I understand fully how they work, and I understand their limitations. Because if you get a chart and you've got 15 indicators on there, good luck getting them all to line up on a buy or a sell. I mean, I get so confused when I look at charts that have all kinds of indicators on it, and all these beautiful mountains and pictures, and I just can't look at it and get a good sense of what's going on. I need to focus on the things I think are important. Price action, volume, relative strength, all of these things are very important to me. And in the last year, I think accumulation distribution is also key. So that's one. The other one that I was asked about was Generac Holdings, and about this big drop right here. Well, first of all, you have to understand Generac was added to the S&P 500, and I think they were removed from the S&P 400, the mid cap. So they went from the mid cap to the large cap index. So a lot of shares had to change hands at the end of the day. So whatever happened that day it's going to be exacerbated by the fact that the volume was massive. If we pull up an hourly chart on GNRC, you can see, where was it? Let me go back and see what that day was. So that was the 19th, March 19th. If we go back and look at the hourly chart on March 19th, here's March 19th. The biggest volume for any hour was just over 400,000 shares. Add up the hours. There wasn't 12 million shares. There was probably, I don't know, maybe there was 1 million shares, if that, probably a little less. That's how many shares traded during the day. It was like 1 million shares. You look at this and you see 13 million. And so it happened to not be a great day that day where we closed near the low. If the normal volume was 1 million shares, you would not have seen this huge drop. The reason you saw this huge drop was because of this, and it's because of the rebalancing. And it happens to any stock that is, Tesla. Remember when Tesla was added to the S&P 500 right here? Look at the volume. So that sent, because it finished strong that day, it actually added to its AD line. Now, the AD line's been strong anyway, hasn't really showed much weakness. So you didn't really notice it as much here as you did on GNRC. But when a company's being added to these various indexes, those shares that change hands, and I'm not a market maker, I don't understand how it all works, but those shares don't show up on a daily chart. They're not buying the stock throughout the day. That's not how it works. Market makers are probably buying for the indexes and then simply just exchanging at the end of the day. So it's just, and in the case of Generac, it was likely, shares coming out of one fund selling and going into another fund buying. So where you're moving from one index to another, it's probably not going to be nearly as much of a big deal as a stock that maybe is just being added to an index and not being removed from another. So anyhow, I just wanted to point that out. So you can't always just look at an indicator. You have to understand their limitations. That would be a limitation. And honestly, until that question came up, I didn't even realize the kind of impact that would have on an indicator like the accumulation distribution. So I learned something in doing this, when that question came up. So thanks for the question. But again, it comes down sometimes to common sense and not buying and selling, not putting thousands of dollars on the line because you saw a line on a chart do something. I really want to try to avoid using technical indicators as the end all be all. Stock's going to go up because this line crossed over that line. Really? That's why you're going to put thousands of dollars, and I'm not saying I haven't done, breakouts or, a move back through the 50-day moving average. That's part of what I look at. But I would just be really careful using recency bias because honestly, that's what this is with the AD line. It's been working for the last year for us, but it's an indicator. It's not price. So just keep it in mind. All right, let's wrap this thing up with the 3 you must see. And I'm going to there was a question also that came up from a member and said, could I compare American Express, Visa, and MasterCard? So I thought that's what we would do just to wrap this thing up. So, and I'll give an update so I can see what's going on today so far. So AXP, okay, AD line, okay, price action strengthening. Relative strength is what I'm going to look at. So I think AXP relative to its peers in finance looking pretty good there. So AXP I think is good. Whoops, there's no A. Then you've got Visa, AD line going down. Relative strength was strong, but it's weakened of late. The group relative to the S&P is weak. When I look at this versus American Express, I think American Express is a no-brainer for me at this point. Last one we'll look at is MasterCard. Same thing with the AD line going down. Very similar looking chart to Visa, which makes sense. I mean, they're very similar businesses. American Express is similar as well, but for whatever reason, they have them in different categories. And they do have different parts of their business, so I shouldn't say that. But they're very similar companies. And when I look at the charts, to me, the best one is AXP. We have pulled back. Let me pull up that AXP because I know AXP's pulled back as well. I just see a better trend, and AD line is better. So if I had to split hairs here, I like the pattern a little bit better on the price action. I also definitely like the fact that the AD is giving me a little bit more comfort here. So I'd pick AXP over the 3. All right, we ran a little late, quite a bit late. Sorry about that. Right now, we got the NASDAQ leading today, so that's good, up about 0.9, so about 0.9%. S&P up. S&P trying to set a new all-time high. Dow trying to do the same thing. NASDAQ just trying to get healthy again. So big differences there. Small caps, mid caps, both having big days again. VIX back down below 20. All good news. WBA reported earnings, by the way, and you can see there at the top of the list on the Dow Jones, up almost 4%, trying to make a breakout. Watch to see if we don't get the breakout on the close. We could have a double top short term. Now, I like the trend here, so I'm fine with Walgreens, and I like the action coming off the 20. I think just if it fails, I'd be careful. We might get a little bit of a pullback, but anything near that 20-day looks good. All right, everybody have a great day. Appreciate you tuning in, and hopefully April turns out to be a little better month for growth stocks than March was. Take care, everybody. Happy trading.